Okay, greetings everybody, and welcome to Victory's virtual workshop, where we unpack complex financial and economic topics to make them accessible for you. I'm Patrick Huey, and today is January 31st, 2024. And today we are diving into a fundamental aspect of your financial plan, and once again, that is taxes. So grab your headphones and something to jot down some notes. And join us as we explore what you'll need to gather in order to be ready for this tax season. Just want everybody to be reminded, feel free to jump into the chat, ask any questions, paste your questions in there, and I'll try to answer as we go along. Here's what that button looks like. Or if there are more personal questions that need to be taken offline, I'll certainly reach out to you afterwards. A transcript of this will be available to you on Friday, as well as a video recap. So let's get going. The IRS began accepting 2023 individual income tax returns this week, Monday, January 29th to be exact. And so it begins. Welcome to the 2024 tax season. If you weren't first in line, that's okay. Perhaps it's even preferable. After all, tax time is a marathon and it's not a sprint. In preparing taxes, and remember, I am an accredited tax preparer, even though I don't make the actual preparation a part of my practice. So I should say, when planning for taxes or tax season, what I've found is it's easiest to gather documents and files centered around the three major components of a tax return. And those are income, deductions, and credits. Now, you can't have income taxes without income. At least not yet. Believe me, they're working on that. So that is where we want to start with our document collection efforts. So first of all, did you earn wages as an employee? If so, obviously you need to collect your W-2 forms, including all the copies showing all the boxes of states and localities, etc. Did you receive or recognize equity compensation, including Section 83B elections? This is an Internal Revenue Code provision giving an employee or founder the option to pay taxes upfront on the fair market value of a restricted equity grant. If so, you need to collect your Forms 3921 and 3922 and be mindful of any adjustments that may be needed. Did you earn income as a self-employed individual? If so, you're going to need your 1099 NEC, 1099 MISC, 1099K, or the like, and gather the documentation of all your income and expenses. Did you have taxable investment accounts and or interest-bearing accounts? If so, you're going to need your 1099B for brokerage, or your 1099D for dividends, or 1099 INT for interest. Sometimes you'll even see the 1099 consolidated or composite. And if you wait long enough, typically by February or March, one of those will have a correction and you'll see a corrected 1099 as well. One of the reasons why we encourage folks to be patient when it comes to filing their taxes. Okay, did you make any withdrawals from a retirement plan or insurance policy, including rollovers, Roth conversions, etc.? If so, you're going to need those 1099-Rs, which are starting to become available as we speak, depending on where those accounts are custodied. Did you receive any sources of retirement income, like pension or annuity or Social Security? If so, you'll need your 1099-Rs or your Social Security 1099. And if you retired from the Railroad Board, it's an RRB 1099. Did you sell your home or other real estate? If so, Form 1099-S is for you. You'll also want documentation of your cost basis. So any improvements you made to your property over time that are going to affect that cost basis, be ready to document. Did you receive any alimony, excluding child support, property settlements, etc., from a divorce that was finalized before January 1st of 2019? If so, you'll need the relevant details, dates of the agreement, etc. And finally, did you receive any other sources of income? Income from IRS Schedule Part 1, maybe, or, that Part 1 of Schedule 1 is where you'll report the following types of income, like taxable refunds of state and local income taxes, alimony received, if, again, it's dated before December 31st, 2018, income or loss from business. Or, if you're in a partnership, you may have gotten a K-1 or be getting a K-1. More on that in a second. If so, gather up those tax forms and any other details that may apply. Now, a note on Schedule K-1. This is an Internal Revenue Service tax form issued annually for an investment in a partnership. And the purpose of the Schedule K-1 is to report each partner's share of the partnership's earnings, losses, deductions, and credits. So Schedule K-1 serves a similar purpose as Form 1099. Now, some investment vehicles, including ones owned in our portfolios, are formed as partnerships. And instead of 1099s, they send K-1s to their investors. Now, I've identified 2 such investments across our investment models that will send out a K-1. If you held either VIXY or IAU in your portfolio, please do not file your taxes until receiving your K-1s. Now, not all investment models have these positions, so if you have questions, feel free to let me know. And remember, March 15th is the deadline for partnerships to issue individual Schedule K-1s to each partner, which will give you just a little bit over a month to file your personal federal income tax returns, which are due on April 18th. If you add all of your income sources together, you will get your gross income. But remember, this is not your taxable income. And that's because first, you have to subtract your deductions. And income minus your deductions will give you a simple calculation of what is called adjusted gross income. Now, for 2023, the standard deduction available to everyone is $13,850 for single filers, and those married filing separately, it's $27,700. I'm sorry, I said that wrong. It's $27,700 for those married filing jointly. In addition to that, you can add $1,500 per taxpayer that is over the age of 65. Okay, if the combinations of the following is greater than the standard deduction, you may choose to itemize your deductions. So, for example, are you self-employed? If so, gather up that documentation of all your deductible business expenses, including the home office, vehicle use, health insurance premiums, long-term care premiums, etc., and check for the potential eligibility for the qualified business interest deduction as well, the QBI. Did you contribute to any retirement plans or other tax advantage accounts? Make sure you have documentation of those deductions. Did you pay a significant amount of medical expenses? If so, gather up any relevant details, amounts paid, but be mindful that there are significant limitations on claiming this deduction, especially there's a 7.5% AGI floor for these deductions, meaning only expenses that exceed 7.5% of the value of your adjusted gross income for medical expenses will be deductible. And that's a pretty high bar to try and get over. Did you pay state and or local taxes? If so, gather up the details on those. But be mindful that the state and local tax limitations are $10,000 on claiming those deductions. Did you pay interest on a mortgage, home equity loan, or home equity line of credit? If so, you'll need your Form 1098 and other relevant documentation about interest paid, points paid, origination dates, etc. And be mindful of the deduction limitations here as well. For example, funds must be used to buy, build, or substantially improve your home if you're deducting for home equity lines. Did you pay any interest on qualified student loans? If so, make sure you've got your Form 1098-E. Did you make any donations to a qualifying charity, including cash, non-cash, property, stock, etc.? If so, get those details together. You're going to need valuation details for gifts of non-cash property. And remember that unlike in the COVID years, if you don't end up qualifying for itemized deductions, then your charitable donations will not be deducted on your taxes. There's no longer a $300 to $600 above the line deduction, regardless of which deduction, standard or itemized, you take. And this is a good time to remind you to consider bunching things like charitable deductions for multiple years. perhaps using a donor advised fund, along with multiple years of things like property tax to help yourself qualify for that itemized deduction when possible. It's very easy to pay your tax at the end of the year in November and then pay tax for the next year in December. And that's what we would call bunching. Finally, to determine taxable income, we subtract any tax credits. And while tax deductions reduce how much of your income is subject to taxes, tax credits directly reduce the amount of tax you owe, giving you a dollar-for-dollar reduction of your tax liability. Tax credit valued at $1,000, for instance, lowers your tax bill by the corresponding $1,000. So it pays to figure out which, if any, of the numerous tax credits out there you may qualify for. Some of the easy ones include, do you have any children, including adopted, or other dependents? If so, you're going to need documentation to prove dependency status and substantiate costs paid. You may need custody and or support arrangements, and you may need IRS Form 8332. Did you, your spouse, or your dependents incur any qualifying education expenses? Let's get out those receipts and check out your 1098-T forms. Did you buy an electric vehicle or make an energy efficient home improvement? Time to get those documents out. Did you, your spouse, or your children obtain health insurance through the marketplace? Make sure you've got your Form 1095-A if that's the case. Did you make any estimated tax payments, or did you apply a tax overpayment from last year towards this year's tax liability? Make sure you have that documented. Are there any other tax credits that you may apply to your situation? Things like the American Opportunity Credit, the Lifetime Learning Credit for education, the Adoption Tax Credit, the Earned Income Tax Credit, the Foreign Tax Credit, and the Retirement Savings Contribution Credit. Make sure that if you think you might qualify for one of those, you have it documented why. And then finally, the catch-all here in miscellaneous. Did you make a qualified charitable distribution or distributions from your IRA last year? Make sure you have copies of the checks or other documentation if so. Incidentally, if you don't know what I'm talking about, and you're over age 70 and a half and are charitably inclined, this is a strategy we should consider for you, especially if you're not currently itemizing your deductions. Okay, so write that one down, and if you have questions about it, want to see if it might apply to you, let's have a conversation about that in our next one-on-one. And folks, there you have it. It's the beginning of tax season 2024 and how to get ready for it. Once again, no questions in the queue. I want to thank you for being with me today. Be on the lookout in the weekly briefing email for the next topic for our virtual workshop next Wednesday. And thanks again, everybody. We'll see you next week.